Welcome to the April 2025 Evergreen Asset Allocation Committee meeting. Without further ado, let's start the meeting with an economic update by MAV. Economic turbulence and stagflationary concerns in a tariff-dominated environment. The Asset Allocation Committee convened against a backdrop of significant market volatility and economic uncertainty. MAV opened the meeting by highlighting the dramatic market movements, with the Nasdaq Composite down approximately 3%, the Dow Jones Industrial Average falling 1.7%, and the S&P 500 declining around 2.25% overnight. This negative sentiment was largely attributed to Federal Reserve Chairman Jerome Powell's comments on tariffs, which indicated growing concern about their economic impact. Powell's assessment marked a shift from his previous stance that tariffs would have only temporary effects. He now acknowledged they would translate into higher inflation, at least temporarily, while noting that although the economy was currently resilient, leading indicators suggested impending weakness. MAV emphasized that the magnitude of the final tariffs would determine the severity of both growth and inflation shocks, potentially culminating in stagflation. The committee had recently revised its forecast regarding Federal Reserve's behavior and now assessed the probability of recession at 50%, a significant change from their previous outlook. The tariffs announced on April 2nd had far exceeded market expectations, with estimates suggesting they could reach as high as 24 percentage points if fully implemented. This prompted an adverse reaction in bond markets, with yields surging dramatically. Within approximately 1 week, Trump announced a 90-day pause, which triggered a substantial short-covering rally across risk assets. MAV suggested this response from the bond market had forced a reconsideration of the timing of interest rate cuts. The Bank of America Global Fund Manager Survey revealed extraordinarily pessimistic sentiment, with 49% of fund managers now expecting a hard landing for the U.S. economy over the next 12 months. The no landing perspective, which had gained significant traction earlier in the year at 38%, had almost completely dissipated to just 3%. Bearish sentiment had reached multi-decade highs, with a net 82% of respondents expecting global economic growth to weaken, the most pessimistic reading in the survey's 30-year history. Additionally, 49% of fund managers were anticipating a global recession, marking the fourth highest recession expectations in 2 decades. MAV noted that tariffs had fundamentally altered the rules of the game, though their ultimate form remained uncertain. Businesses, households, investors, and nations were being forced to rapidly address these challenges. Recent data from China, which reported GDP growth of 5.4% year-on-year against expectations of 5.2%, highlighted how exports had already changed behavior, potentially creating artificially elevated growth in the short term that could lead to significantly weaker outcomes in the not-too-distant future. Talking about monetary policy and inflation in a complex rate environment. The committee's discussion turned to the implications of current developments for monetary policy globally. MAV outlined how the original view that the Federal Reserve had finished cutting rates for the year had been abandoned, with renewed expectations for further cuts. Current market expectations indicated only a 20% likelihood of a May rate cut, but stronger expectations for cuts beginning in June, with markets positioned for 3 cuts by late October and potentially another by early 2025. However, MAV expressed skepticism about this trajectory, suggesting that a rebound in inflation later in the year might limit the Fed to just 2 cuts in 2025. For Australia, the outlook differed significantly. Markets were pricing in a near-certain 25 basis point cut by the Reserve Bank of Australia on May 20th, with a 24% probability of an additional 25 basis points. Further cuts were anticipated in July and again by September or November. MAV suggested the RBA might be more cautious about later cuts, particularly if house prices rebounded strongly, to avoid inflating another bubble. Similar expectations of multiple rate cuts applied to the European Union and the United Kingdom. With markets anticipating at least 3 cuts in the EU before year-end, and a couple of cuts from the Bank of England between the present and August. The Bank of Japan presented a contrasting case. Having gone through decades without significant inflation, Japan was now experiencing inflation alongside strong wage growth. However, market expectations for future rate increases had moderated, with only a 50% probability of another rise by September, down from earlier full pricing. Mav noted how the Bank of Japan's surprise move in August of the previous year had rapidly destabilized markets. For Canada, which had already implemented several rate cuts, one or two more reductions were anticipated. Yield curves had steepened dramatically compared to the previous year, when much discussion had centered on curve inversion. The US term premium had risen to 71 basis points as of April 10th, approaching levels seen during periods of significant market stress. In Australia, a notable crossover had occurred between inflationary expectations and real interest rates, with the former declining while the latter increased as nominal rates remained relatively stable around 4.35 to 4.40%. Mav suggested this might provide additional justification for the RBA to cut rates, as the Australian economy might struggle to sustain such high real interest rates. Regarding inflation, Mav highlighted that core CPI in the US had finally broken below 3% after 47 months above that level, while questioning whether it could reach 2%. Both the quarterly annualized CPI and PPI had rolled over, largely due to dramatic falls in energy prices. However, Mav expressed concern that these metrics might rebound to 3.5 to 4% later in the year, which would disappoint market participants and complicate the Federal Reserve's ability to meet current interest rate expectations. The committee drew parallels between the current situation and the stagflationary period of the 1970s, noting that the current trajectory of inflation following its pandemic-era peak resembled the pattern seen in that earlier period. Mav consistently raised concern that inflation would be problematic in the second half of 2025 and suggested the tariff shock could potentially have cascading effects beyond a one-off price increase, potentially leading to sustained inflationary pressures. Moving on to gold's resurgence and defensive positioning in an uncertain landscape. The committee devoted significant attention to gold's performance and prospects, responding to numerous inquiries. Mav noted that gold had emerged as the top-performing asset class amid recent market turbulence, rising nearly 36% over the past 12 months, with 7.5% growth year-to-date and 20% over the trailing three-month period as of April 14th. The committee members expressed varied perspectives on gold's role in portfolios, but converged on its growing importance as a defensive asset. Stephen Duchesne observed that in the current environment of low growth, relatively high inflation, and geopolitical uncertainty, gold had become a credible alternative and diversifier. Although gold had performed well, Duchesne suggested it could continue to strengthen if economic conditions deteriorated further. Kingsley Jones highlighted that central banks outside the G7 had fundamentally changed their gold buying behaviour since 2008, with Russia, China, and other global South nations accumulating substantial positions. Jones specifically linked recent gold strength to two factors: US actions to confiscate Russian assets, which eroded confidence in the US financial system, and discussions about terming out US obligations, with officials like Stephen Mira and Scott Bessant not dispelling speculation about potential very long-dated debt issuance. Jones suggested that if the US failed to address these concerns, gold could potentially reach as high as $5,000 per ounce, driven by nations prioritizing financial stability as a core national security concern. He recommended measured buying rather than aggressive positioning, warning that hedge funds might periodically sell gold violently to meet margin calls, creating volatility. Jones also noted that Australian gold mining companies were extremely profitable but remained underappreciated by domestic brokers and analysts. Mav added that the US government might not be displeased with rising gold prices, as it could potentially monetize gold reserves currently carried on its balance sheet at approximately $42 per ounce. Market-to-market revaluation could modestly improve the US debt position, though it would remain substantial. The discussion of market valuations revealed that Australian equities were trading at a 20% premium to historical averages as of March, with a yield of approximately 3.5% compared to the historical average of 4.1%. The committee characterised the Australian market as expensive, but suggested that domestically focused financial services might offer relative shelter from global trade disruptions. Despite recent market declines, the Australian market's price-to-earnings ratio remained elevated at 18.5, indicating it was not yet presenting broad value. MAV emphasised that active management would become crucial in the current environment, as the rising tide that had lifted all assets was subsiding. He cautioned against rushing to buy the dip, suggesting that deeper market corrections might occur. For Australian investors with international exposures, MAV noted the committee would consider increasing hedging ratios if the Australian dollar consistently traded below 60 US cents, though it had thus far only briefly touched that level intraday. The committee's overall assessment pointed to defensive positioning being appropriate given the unusual combination of potential growth shocks, inflation persistence, and heightened geopolitical tensions. Next, global trade tensions and stagflationary implications for international markets. The committee addressed the profound implications of emerging trade tensions, particularly the tariffs proposed by the Trump administration. MAV emphasised that these tariffs fundamentally altered the rules of the game for global economic interactions. The unprecedented scale of the tariffs announced on April 2nd had shocked markets, with estimates suggesting they could reach as high as 24 percentage points if fully implemented, a level that would almost certainly trigger a recession. While the committee expected the final tariffs to be negotiated downward from initial proposals, the magnitude remained uncertain. The subsequent announcement of a 90-day pause had provided temporary relief, but the underlying tensions remained unresolved. MAV noted that businesses were already modifying their behaviour in response to these developments. The committee observed that trade relationships between the United States, Canada, and Mexico would be particularly affected given their complex supply chains, with intermediate goods frequently crossing borders multiple times before final assembly. Stephen Duchesne noted that Trump had already indicated possible concessions for automakers regarding parts imported from Mexico and Canada, conditional on eventual reshoring of manufacturing to the United States. The committee anticipated further carve-outs as industries and countries lobbied for exceptions, reflecting the complexity of North American regional supply chains. The impact on fixed income markets had been especially pronounced. Bond yields had surged dramatically in response to the tariff announcements, with the US 10-year Treasury yield reaching an intraday high of 4.58% before the 90-day pause announcement, subsequently moderating to around 4.28%. Real rates had experienced similar volatility, with 10-year TIPS yields rallying to below 2% before backing up to well over 2%. The 30-year TIPS was showing real rates just over 2%, the highest level since before 2010. An intriguing divergence had emerged between major bond markets, with Chinese 10-year bonds moving in the opposite direction to US Treasuries. While US bonds sold off, Chinese bonds were heavily bought, driving the Chinese 10-year yield down to 1.6%, having previously been at 2%. The committee concluded that these developments reflected a fundamental shift in the global economic landscape, with implications extending well beyond the immediate market volatility. The combination of trade tensions, inflation concerns, and divergent monetary policies created an unusually complex environment for investors, warranting defensive positioning and careful security selection. All right, moving on. This month, the next discussion will be around Australian fixed income, presented by Anthony Kirkham from Western Asset Management. Shifting yield curves and rate cut expectations amid tariff disruption. Anthony Kirkham from Western Asset Management observed that global financial markets were experiencing significant disruption in response to President Trump's proposed tariffs. The bond markets had become exceedingly volatile, with the US 10-year Treasury yield reaching an intraday high of 4.58% before moderating to approximately 4.28% following Trump's 90-day tariff pause announcement. Kirkham noted that these extraordinary movements in fixed income markets were instrumental in compelling Trump to reconsider his tariff implementation timeline. Kirkham outlined Western Asset Management's revised global outlook, indicating that economic growth was likely to moderate more rapidly than previously anticipated, even if the tariffs were immediately withdrawn. The loss of momentum resulting from delayed investment and business caution had already created a dent in growth projections. While inflation had been trending towards central bank targets in most regions, service inflation remained persistently sticky, particularly in the United States. This US exceptionalism was partly attributed to more aggressive fiscal spending compared to other developed economies. Regarding policy rates, Kirkham expected a downward trend globally, with the notable exception of the United States, where the tariff-induced inflationary pressures could complicate the Federal Reserve's path. Real interest rates remained restrictive across most developed markets, providing central banks with scope to implement further rate cuts. The yield curves had experienced exceptional volatility, with the short end moving aggressively lower, while the long end struggled amid fiscal concerns and supply issues, particularly in the US Treasury market. Market expectations for rate cuts had shifted dramatically, with participants pricing in approximately 3 cuts for the US Federal Reserve by year-end, bringing rates to around 3.4%. For Australia, the market was anticipating nearly 5 cuts before December, which Kirkham viewed as overly aggressive given the Reserve Bank of Australia's reluctance to cut rates so precipitously. The RBA would likely be influenced by the first quarter inflation figures due for release on April 30th, with these data potentially determining whether a May rate cut would materialise. Kirkham contrasted the US and Australian employment situations, noting that Australia's unemployment rate of 4.1% remained significantly below its pre-pandemic level of 5.1%. This stood in stark contrast to countries like Canada, where unemployment had risen above pre-pandemic levels to approximately 6.5%. He gave credit to the RBA's more measured approach to rate increases, which had helped preserve employment gains, though he acknowledged the challenge of balancing this achievement against broader economic considerations. While he had previously anticipated 2 further RBA cuts in 2025, Kirkham had revised this to 3 additional cuts, primarily due to the potential impact of the tariff issues on global growth. The Australian economic resilience and credit market dynamics. Anthony Kirkham presented a cautiously optimistic view of Australia's economic position, suggesting it remained relatively resilient despite global headwinds. The combination of easing inflation, improving real wages, and the implementation of tax cuts in 2025 had strengthened consumer finances, allowing households to begin rebuilding savings buffers that had been eroded during the cost of living crisis. This improvement was reflected in consumer confidence surveys, which had recovered from the extreme lows experienced through 2022 to 2023. Kirkham observed signs of green shoots within the economy, though he cautioned these improvements were modest and could be undermined by China's economic challenges, given its position as one of Australia's primary export markets. Kirkham highlighted Australia's relatively sound fiscal position compared to many other developed economies. While acknowledging increased government debt levels, he emphasised that Australia retained significant capacity to provide fiscal support should economic conditions deteriorate further. This fiscal flexibility represented an important advantage in navigating potential global economic disruptions. The credit landscape in Australia was characterised as fundamentally sound, with Kirkham expressing confidence in how executives had managed corporate balance sheets throughout the pandemic and subsequent recovery period. He pointed to the defensive nature of Australia's credit market, highlighting the prevalence of companies with monopolistic or duopolistic market positions that had weathered inflationary pressures effectively due to their pricing power. Additionally, he noted the increasing proportion of regulated infrastructure assets within the Australian credit market, including ports, airports, electricity transmission infrastructure, and toll roads. These assets, often owned by superannuation funds focused on long-term returns rather than short-term profit maximisation, provided relatively stable investment opportunities. However, Kirkham identified concerning trends in corporate insolvencies across Australia. The data presented showed rising failures, particularly in construction and hospitality sectors. Similarly, restaurants and leisure businesses had experienced heightened failure rates as consumers reduced discretionary spending. Kirkham noted that these vulnerable sectors represented significant exposures within some private credit portfolios, suggesting potential risks for investors in that space. Regarding bond market dynamics, Kirkham explained that normalised yields had restored the traditional defensive characteristics of fixed income investments. Bonds had regained their capacity to rally during risk-off periods, providing portfolio diversification benefits that had been largely absent during the extended low-yield environment. However, he expressed surprise at the long end of the yield curve steepening so aggressively during recent market stress, questioning whether Australia would maintain its historical correlation with US Treasury movements given the significant divergence in fiscal positions between the two countries. The credit spread environment evolved considerably, with Australian corporate bonds offering relatively attractive valuations compared to their US counterparts. Kirkham noted that Australian credit spreads had previously widened due to outflows from Japanese investors, creating opportunities for active managers to increase allocations to these sectors. He specifically highlighted supranational agencies, SSAs, which had traded at spreads exceeding 100 basis points over government bonds, representing exceptional value for AAA-rated securities. Kirkham described how his team had capitalised on this dislocation before neutralising the position as spreads subsequently narrowed. Idiosyncrasies in Australian fixed income markets and the evolving semi-government sector. Anthony Kirkham drew particular attention to an unusual development within Australian fixed income markets. Semi-government bonds had moved to trade at wider spreads than supranational agency SSA securities. This represented a significant inversion of the historical relationship, wherein semi-government bonds had typically commanded tighter spreads. Kirkham attributed this anomaly to excessive supply from state governments, which had collectively become larger issuers than the federal government. The dynamics behind this shift were complex and multifaceted. In late 2021, Australian banking regulators had mandated increased holdings of semi-government bonds by banks, creating substantial institutional demand that initially absorbed the supply. However, as banks fulfilled their regulatory requirements, their incremental purchases diminished significantly. Concurrently, state governments continued aggressive borrowing to fund ambitious infrastructure programs, creating a structural supply-demand imbalance that drove spreads wider. This widening was most pronounced at the longer end of the yield curve, particularly in the 7 to 10-year segment. The 3 to 5-year portion of the curve had been relatively insulated, as banks continued to concentrate their regulatory-driven purchases in shorter maturities. Responding to this market dislocation, Western Asset Management had positioned its portfolios with a 5 to 6% underweight to semi-government bonds, particularly avoiding shorter maturities where they preferred corporate credit exposures. Credit rating concerns further compounded the semi-government spread widening. Victoria had already experienced a double downgrade, while Queensland's fiscal trajectory was becoming increasingly concerning, with projections suggesting its debt as a percentage of state product could eventually exceed Victoria's. Kirkham indicated that semi-government bonds could represent attractive investment opportunities if state governments demonstrated greater fiscal discipline. But until such restraint materialised, the supply overhang would likely continue to pressure spreads. Kirkham noted that offshore investors, including China Investment Corporation, had begun exploring potential value opportunities in the Australian semi-government sector. While international investors typically viewed Australian semi-government bonds as high-quality securities, they required sufficient spread compensation to justify purchases given the ongoing supply pressures. Another noteworthy market development was the compression of spreads in Australian residential mortgage-backed securities, RMBS. Kirkham highlighted that lower-rated tranches had experienced dramatic tightening, with BBB-rated securities moving from spreads of approximately 400 basis points to below 200 basis points. This contraction reflected intense investor demand for yield, particularly from cash-plus investment funds seeking to enhance returns. Kirkham questioned whether investors were receiving adequate compensation for the inherent risks and illiquidity associated with these subordinated tranches, suggesting the hunt for yield had potentially led to mispriced assets in this sector. Despite these concerns about specific segments, Kirkham maintained a broadly constructive view on Australian credit markets. He emphasised the diversified nature of recent issuance, highlighting the presence of high-quality international banks seeking to diversify their funding sources through the kangaroo market, foreign issuers in Australian dollars. Infrastructure assets represented another significant portion of credit issuance, with many such assets now owned by superannuation funds focused on long-term sustainability rather than short-term profit maximisation. Kirkham illustrated this ownership advantage through the example of Melbourne Airport during the pandemic. When passenger numbers collapsed, superannuation fund owners instructed management to prioritise balance sheet integrity over dividend payments, even providing additional capital to navigate the crisis. From a bondholder perspective, this long-term ownership orientation represented an ideal alignment of interests, providing implicit support for creditworthiness beyond financial metrics. Market volatility and global rate dynamics. Following the Trump tariff shock. The final segment of Anthony Kirkham's presentation addressed the extraordinary bond market volatility witnessed in early April 2025 following President Trump's tariff announcement. This period represented one of the most tumultuous episodes in recent fixed income history, with record-breaking price movements across global bond markets. While media attention focused primarily on the US Treasury market, similar severe dislocations occurred across Japanese, British, and European government bond markets. Kirkham attributed this exceptional volatility to a confluence of technical factors that amplified the fundamental concerns about tariff-induced inflation. He referenced a global macro call from that morning, which highlighted the forced unwinding of 30-year asset swap positions by hedge funds as a significant destabilizing factor, particularly in the Japanese market. These trades, which had previously generated consistent returns with seemingly limited risk, suddenly required rapid liquidation as markets repriced inflation expectations and term premiums, triggering a self-reinforcing cycle of selling pressure. The timing of this market disruption proved particularly problematic as it coincided with a series of major US Treasury auctions. Kirkham noted that the 3-year auction had performed poorly, exhibiting a significant tail difference between average and highest accepted yields, raising concerns about whether subsequent 10-year and 30-year auctions would attract sufficient demand. This combination of hedge fund deleveraging and auction supply created what Kirkham described as genuine panic selling, the first such episode observed throughout the recent period of market turbulence. Kirkham suggested that this market dysfunction ultimately influenced policy decisions, asserting that officials from the US Treasury and Federal Reserve likely advised President Trump about the severe market reaction, contributing to his decision to announce a 90-day pause on tariff implementation. Market stabilization had become a pressing policy priority as institutions recognized the potential for broader financial contagion if the volatility persisted. The capacity of market intermediaries to absorb the extraordinary selling pressure had been severely constrained. Primary dealers had already accumulated substantial inventory positions following a period of heavy issuance, leaving them with limited appetite to take on additional risk as market conditions deteriorated. This lack of intermediary capacity exacerbated price movements and contributed to the temporary breakdown in market functioning. In the final section of this podcast, Rick Quinn from Bentham Asset Management gives an update on global fixed income and credit markets, post-COVID inflationary dynamics, and the impact of tariff policies. Richard Quinn from Bentham Asset Management provided a nuanced analysis of global economic conditions, emphasizing how the post-COVID economy had transitioned from a supply-side inflation shock to a more complex landscape with emerging policy risks. Quinn observed that most central banks had successfully navigated inflation back into manageable ranges, with prices stabilizing and, in some cases, beginning to decline. He highlighted that energy prices had moderated significantly, though food costs remained somewhat elevated. This changing inflationary dynamic suggested that supply-side pressures had largely abated. The committee's primary focus turned to the economic implications of substantial tariffs proposed by the Trump administration. Quinn characterized these tariffs as fundamentally problematic from an economic perspective, despite acknowledging some marginal potential benefits. He provided a clear assessment, stating, "Tariff equals tax," and explained that such measures typically create a one-off inflationary shock. Drawing a parallel to Australia's experience with the Goods and Services Tax, GST, Quinn suggested markets might eventually look through this temporary inflation spike. However, he expressed concern that the transition to what he termed a tariff economy risked higher structural costs for consumers and businesses. The critical issue identified was not the immediate effect on inflation readings, but the potential for inflation expectations to become unanchored. Quinn pointed out that inflation expectations had suggested people believed inflation might be getting out of control, but the actual inflation data hadn't reflected that shift yet. This distinction between actual inflation and expectations highlighted the precarious position of central banks, particularly the Federal Reserve, which faced an especially complex challenge due to its dual mandate of price stability and employment. Employment indicators were showing concerning early signals according to Quinn. He referenced the Challenger job layoff series, which had reached 275,000 positions, exceeding levels observed during the 2008 financial crisis. These job losses were expected to have a multiplier effect, with Quinn stating that the knock-on effect from government employees losing their job is 2 to 3 jobs. He predicted this employment deterioration would negatively impact consumer confidence and consumption, potentially offsetting some inflationary pressures and allowing central banks to look through the tariff-induced price increases. The timing of the tariff announcement created additional complications, as it represented a significant external shock, just as many economies were entering what Quinn described as the drop zone for the long and variable lag of monetary policy implementation. With approximately 18 months having passed since major central banks began aggressive tightening cycles, economies were only now fully experiencing the impact of higher interest rates. The addition of a tariff shock at this juncture created what Quinn characterized as policy experimentation with fringe policy ideas that he deemed dangerous. Regarding central bank positioning, Quinn observed that most major monetary authorities were now either on hold or beginning cutting cycles. He noted that Australia's Reserve Bank was the last to move and the least to move, signalling a more cautious approach compared to international counterparts. This positioning created divergent interest rate paths across major economies, with markets pricing in approximately 3 Federal Reserve cuts in 2024 versus more aggressive expectations for Australia, the European Central Bank, and the Bank of England, each projected to implement multiple reductions before year-end. Overall, Quinn's assessment suggested that while headline inflation had moderated, policymakers faced a complex array of challenges from tariff-induced price pressures, deteriorating employment conditions, and the lagged effects of previous monetary tightening. The committee recognized that these intersecting forces created an uncertain outlook for both inflation and economic growth in major economies. Fixed income markets and the reassertion of bond value in portfolios. Richard Quinn presented a contrarian view on government bonds, identifying them as a compelling investment opportunity despite widespread negative sentiment. He argued bonds were the cheapest they've been to equities since the early 2000s, using the inverted forward price-to-earnings ratio of the S&P 500 compared to yields on the entire Treasury index. This relative value proposition had emerged after an extended period during which long bonds had been underperforming shorter treasuries. For Australia specifically, Quinn highlighted that the cash rate was sitting below the bond rate, creating an opportunity to lock in higher yields through longer-dated securities. The committee explored concerns about bond market volatility, which had been particularly pronounced during recent market disruptions. Quinn acknowledged elevated volatility, but placed it in context by comparing it favourably to the lunatic fringe of volatility witnessed in emerging market bonds, listed property trusts and growth equities. He presented compelling evidence that government bonds continued to provide effective diversification benefits, showing that during a recent 5.3% decline in the S&P 500, Treasuries had gained 2.4%. This negative correlation between bonds and equities during periods of market stress underscored what Quinn described as the asymmetry of returns in fixed income, where a 1% decline in interest rates generated a larger positive return than the negative impact from a 1% increase. Quinn's positive assessment of government bonds contrasted with his more cautious outlook on credit markets. He characterized credit spreads as having rallied far too far prior to recent volatility, creating conditions where investors had become way too complacent about credit risk. This complacency was evident in the timing of substantial allocations to private credit vehicles, which had occurred precisely when liquid credit spreads had reached their tightest levels since 2006. Quinn criticised this trend, noting that investors were effectively locking into illiquid positions with inadequate compensation for risk. Examining high-yield credit specifically, Quinn reported that spreads had widened considerably from their lows, with the credit default swap (CDS index) approaching 500 basis points before retracing approximately 100 basis points and subsequently bouncing back to approximately 450 basis points. While acknowledging this represented a meaningful correction from the tightest spread levels, he anticipated further deterioration as corporate earnings weakened. Quinn projected earnings downgrades to credit ratings, and some defaults, though qualified that default rates might prove less severe than in historical cycles due to private debt having taken out some of the defaulting assets. Within the credit universe, Quinn identified relative value opportunities in specific sectors. He expressed a contrarian positive view on Australian semi-government bonds, particularly longer-dated issues. Quinn differentiated the current semi-government risk profile from the 1990s, noting that Australian states now received a percentage of GST revenue, enhancing their financial stability. He also highlighted collateralised loan obligations, CLOs, as providing superior credit spread per unit of credit risk, though acknowledged these had also experienced some widening amid recent market turbulence. The comparison between high-yield bonds and leveraged loans revealed a significant shift in relative value, with high yield previously trading 200 basis points tighter than loans, but now only 100 basis points tighter. Despite this compression, Quinn maintained a preference for loans over high-yield bonds, anticipating further spread widening in the latter category. Treasury market disruption and unconventional policy risks. The committee devoted considerable attention to the recent dysfunction in US Treasury markets, which Quinn characterized as the unwinding of a highly leveraged trade rather than a fundamental reassessment of US government creditworthiness. He explained that what some observers had termed a Treasury apocalypse or swap apocalypse primarily reflected the forced unwinding of swap spread trades. These trades involved purchasing Treasury bonds while simultaneously hedging interest rate risk through interest rate swaps, seeking to capture the spread between Treasury yields and swap rates. The scale of this unwind was substantial, with Quinn referencing industry estimates that $1 trillion of basis trades might have been unwinding simultaneously. This extraordinary volume overwhelmed dealer capacity, which was itself constrained by post-global financial crisis regulations. Quinn specifically identified the supplementary leverage ratio, SLR, requirements as problematic, noting they imposed capital costs on banks for holding Treasury securities. The combination of leveraged position liquidations and regulatory limitations on dealer inventory capacity created what committee member Stephen Duchesne described as a massive liquidity issue. The market disruption followed a poorly received Treasury auction, though Quinn noted that subsequent auctions had performed well. He described the sequence of events as a liquidity crisis rather than a credit event, observing that foreign investors, particularly Japanese institutions, had contributed to selling pressure as they engaged in a dash for cash. However, Quinn dismissed speculation that Chinese authorities had been significant sellers of Treasury securities, stating that it was not in their interest to do it and noting China's Treasury holdings remained substantial. Against this backdrop, the committee explored concerning policy proposals circulating within the Trump administration regarding Treasury debt management. Quinn responded with remarkable vehemence to suggestions about potential maturity extensions for Treasury debt, essentially forcing bondholders to accept longer maturities than originally contracted. Quinn emphasized that such actions would constitute a default by restructuring and that they would fundamentally undermine global confidence in U.S. financial markets. He equated such techniques with distressed debt restructurings in high-yield or emerging markets. When committee member Kingsley Jones questioned why newly appointed Treasury official Scott Bessent had not publicly opposed these proposals, Quinn expressed confidence in Bessent's judgment. Quinn speculated that Bessent would resign rather than implement such policies. The implications of such unconventional policies would be severe for global financial markets, according to Quinn. He argued the reserve currency status represented an absorbent privilege that allowed the United States to keep borrowing. Abandoning established norms of Treasury market functioning would jeopardize this privileged position. Quinn illustrated the potential consequences with a stark comparison, suggesting Treasury bonds under such a regime would be less attractive than Brazilian bonds in terms of risk profile. The discussion further explored the Treasury market functioning in relation to global liquidity conditions and currency dynamics. Quinn addressed speculation about potential US dollar devaluation, suggesting American policymakers would be reluctant to surrender the benefits associated with reserve currency status. He characterized recent market turbulence as potentially representing the early stage of deleveraging, with the swap spread trade collapse as the early signs. This deleveraging process was evident in performance of leveraged business models, with Quinn noting that private equity firm KKR had declined approximately 50% from its peak. These Treasury market dynamics highlighted a broader theme about investor behavior during market stress. Quinn criticized the tendency for investors to sell the most liquid assets first during periods of volatility. This pattern had been evident even in gold markets, despite their traditional safe haven status. Quinn advocated maintaining liquidity during market disruptions rather than liquidating the most marketable assets first, a recommendation that aligned with his cautious positioning across asset classes. Global macroeconomic imbalances and China's financial evolution. The discussion between Richard Quinn and the committee explored the complex interrelationship between China's economic challenges and global financial markets, particularly focusing on the significant divergence between Chinese and American government bond yields. Kingsley Jones highlighted how Chinese 10-year government bond yields had declined from 1.9% to 1.6% during the period of U.S. Treasury market stress, noting that this movement occurred despite China facing challenges due to structural economic challenges. Quinn broadly agreed with this assessment of China's structural challenges, but focused on the implications for financial markets. He observed that the spread between Chinese 10-year yields and US 10-year yields had dramatically shifted, moving from negative 2% with Chinese yields below US yields to positive 2%, with Chinese yields above US yields. This substantial repricing reflected divergent monetary policy trajectories, with Chinese authorities easing financial conditions while the Federal Reserve maintained relatively tight policy. Although Quinn acknowledged that Chinese markets were not investor-friendly for most global investors due to capital controls and other restrictions, he suggested these yield movements carried significant implications for the international financial architecture. The discussion extended to China's long-term aspirations regarding currency internationalization. Quinn reflected on how perspectives had shifted over the past decade, noting that 7 years earlier, market observers had been looking at China as dominating in so many areas and potentially emerging as the new power coming through to overtake the old power being the US. This transition would traditionally involve the emerging power's currency assuming greater international prominence, potentially challenging the established reserve currency. However, Quinn identified two fundamental obstacles to Chinese currency internationalization: lack of full convertibility and questions regarding governmental trustworthiness. The committee considered the potential for significant changes in the international monetary system, including speculation about US dollar devaluation. Quinn acknowledged this possibility but emphasized the substantial benefits America derived from dollar hegemony. He expressed skepticism that American policymakers would voluntarily relinquish these advantages, despite growing challenges to the international monetary system. These currency dynamics connected to broader discussions about economic imbalances affecting both developed and emerging economies. Quinn observed that higher interest rates were forcing public and private borrowers to reassess their debt capacity and spending plans. He used the example of Victoria, Australia, to illustrate this point, describing the state as having engaged in unsustainable spending in a higher interest rate environment. Similarly, Quinn noted that Scott Bessent, newly appointed to a senior US Treasury position, was advocating for reducing the American fiscal deficit gradually. This reflected growing recognition that even the world's reserve currency issuer faced constraints on sustainable deficit spending levels. Quinn characterized the process of deleveraging as potentially detrimental to the global economy, reinforcing his cautious outlook. The conversation touched briefly on structural economic challenges facing multiple major economies. Quinn acknowledged elements of stagflation had been present during the COVID period, but distinguished current conditions from the 1970s experience, which had been driven mainly by energy. This made current energy price trends a critical indicator for assessing stagflationary risks. He expected rising unemployment combined with shock inflation from tariffs, but maintained that underlying disinflationary forces remained stronger than commonly recognized. Technological disruption received limited attention, but emerged as a significant theme when discussing China's evolving economic model. Quinn highlighted the success of deep-seek artificial intelligence technologies as representing technological development within China, potentially challenging established industries in energy storage and other sectors. He characterized these technological shifts as an issue, suggesting some heavily leveraged investments in traditional sectors could underperform. Despite these substantial concerns, Quinn maintained that markets would eventually stabilize. Quinn concluded by suggesting the recent Treasury market disruption might signal a return to an era where more attention is paid to the bond market after a prolonged period where fixed income had been relatively neglected by investors and market commentators. With that, we can now move on to summarize all the discussions and frame a portfolio construction strategy. The committee assessed growing macroeconomic uncertainties, highlighting concerns about inflationary pressures from proposed tariff policies, deteriorating employment indicators, credit market vulnerabilities, and bond market volatility. Members discussed stagflation risks, comparing current conditions to historical precedents like the Smoot-Hawley tariffs, while noting markets had shown surprisingly muted reactions to tariff announcements. The committee identified regional vulnerabilities, particularly in US markets, which comprise 70% of the MSCI World Index, predicting significant earnings impacts in upcoming reporting seasons. Australia's complex position was examined, with potential simultaneous deflationary pressures from redirected Chinese exports and inflationary pressures from currency depreciation. The committee noted divergent interest rate trajectories globally, with Australian duration potentially decreasing while US Treasury securities faced significant volatility as markets determined whether tariffs represented structural inflation or a temporary phenomenon. The committee agreed to adopt a more defensive portfolio posture through several measured adjustments while maintaining the strategic asset allocation framework. Specific changes included reducing international equity exposure, particularly US equities, by 4 to 5%, modestly reducing duration exposure in Australian and global fixed income, increasing cash allocations beyond the current 4% benchmark, and potentially introducing further gold exposure for inflation protection. The committee maintained their value tilt and non-US orientation within the remaining equity allocation. For fixed income, members agreed to reduce their slight overweight in global duration to align with the 12% strategic benchmark while maintaining exposure to high-quality credit, which was characterized as defensively positioned with high-grade, short-dated, floating-rate instruments. The committee considered alternative investments including gold, volatility-focused strategies, and currency trading approaches for portfolio diversification, while expressing preference for global listed infrastructure over global REITs due to superior inflation pass-through characteristics. And with that, we can conclude this month's asset allocation meeting.